Bonds continue to drop, but stocks seem to have found support and are slowly starting to move higher. All of that happens while the US dollar is pulling back, but still in a very strong uptrend, while Bitcoin remains in a very narrow trading range. Hello Sector Watchers, welcome to the show. This is the 149th episode of Sector Spotlight for Tuesday the 25th of October, and I'm recording it on Monday the 24th. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. Today is the last Tuesday of the month, which means that we will take a look at seasonality. I'll start with a look at seasonals for the S&P 500 as a whole and then dive into the seasonal patterns for sectors as you are used to. Ladies and gentlemen, this is Sector Spotlight. This week I want to quickly go over the asset class rotation as we spent quite a bit of time in last week's episode, and those rotations did not, well, at least the weeklies did not change too much. We have the weekly rotation on the left and the daily on the right, and as you can see, Bitcoin remains very detached from the center of the chart. Way up inside the improving quadrant in the top left-hand corner. It's picking up relative momentum, but it's still very far away from the center of the chart, so it's still very much in a relative downtrend versus VBINX. It's quite different on the right-hand side where we see the tail of Bitcoin traveling through weakening. It's now heading towards lagging, but it's already leveling off in terms of relative momentum. So we have to wait and see what happens there. But especially the fact that the weekly tail is so far from crossing over the 100 level still makes me cautious, at least compared to VBINX, which is a balanced index fund comprising of equities and bonds, 60% stocks, 40% bonds. So I'm going to take this one off here, fit it so we can get a better handle on what's going on. And we can see that the US dollar remains very strong. It's still inside the leading quadrant, pointing further into it, so it's a strong RRG heading. And if we compare that with what's going on the daily RRG, you can see that the daily tail for the US dollar is inside weakening. It's still at a very high RS ratio reading, so it remains a very strong trend for the US dollar, but it's going through some sort of a correction. I'm also going to toggle that off here on the weekly to get more clarity for the others, because that's where the meat of the rotations are. Let me take away the commodities as well. Discussed that last week. And then you can see the picture very clearly where stocks and corporate bonds, this is a bit out of whack, those corporate bonds. Usually these three fixed income tails move together, so there's something weird going on there. The most important thing is that the tail for SPY is still moving further into the lagging quadrant, while fixed income, government bonds and high yield bonds are moving up. That is very contrary on the daily RRG, where you see that SPY is now actually picking up. Today was a good day in relative terms. You can see that last segment really standing out. And you can see that corporate bonds is deteriorating further together with government bonds and high yield. Commodities following through, and the US dollar we already discussed, and so did we with Bitcoin. Where does that, which charts are the most important? I think that bonds are definitely worth our time, because if you look at IEF and GOV, this kind of similar, you see a very steep downtrend. That is, bond yields are rapidly rising, following this steep drop in the price of bonds, and there's no end in sight at the moment, at least not in the near term. So that remains a dangerous factor for the stock market. Usually when yields go up, stocks don't really like that. And we'll have a look in a minute on how the stock market responds to that. The other asset class, the other asset is the US dollar. And what you see here is the price of euro dollar. So when this goes down, the dollar goes up. So this strong downtrend in euro dollar is actually an uptrend for the US dollar. And you can see that we're pulling back a little bit in this trend. There is still quite a bit of room to maneuver for euro dollar. It looks as if we're hitting upon an overhead resistance level around 98.5, 99. And if we look at the daily chart, we can see that in a little bit more detail. 98.75 is overhead resistance, and the falling trend line comes in around 995.995. So I hope you agree with me that this downtrend is still very much in play, using dollar strength with a little pullback right now in favor of the euro, but the question is for how long. If we look at stocks, that's where things are getting more interesting. I think we're still in a downtrend. If you look at this weekly chart, lower highs, lower lows, the last three major peaks are lining up nicely. That makes a trend. And the last major lows are also all lower. So that rhythm of lower lows and lower highs is still in play. Nevertheless, it looks as if the last 4 weeks we've been playing around with that 360 support level. And so far it's holding up. And we're now rallying out of that support zone around 360 with a dip to 348, but that close was back up towards that 360 area 2 weeks ago. So this is last week, 2 weeks ago. And we're now pushing further up. And this is the last bar is today. It's Monday, the 24th. And we're pushing against the first intermediate resistance level on the way up, which is the high of the week of 3 October, which is, let's say, rounded off at 380. If we look at the daily chart, and we can see that in more detail, you can see that we're actually bouncing right up there. We talked a lot about divergences in the last few episodes of Sector Spotlight. I told you that I don't like it when divergence is formed or called while in between the bottoms the RSI was significantly above 50, like it was here on that weekly chart. That to me doesn't really do it. I've drawn it in, but doesn't really do it for me. But on the daily, you can see a very nice divergence. Here we just touched that 50 level, never really went above it. So this is a very nice divergence that's playing out, and we're now going above those highs. That is strong. And as I told you, divergence is just a setup. You need a trigger to actually be able to act on it. And it looks as if we got the trigger here on the 18th. Which was the day of Sector Spotlight, which I had recorded while we were still here. So we got that first trigger, and now we got the second trigger as we are taking out that previous high. So that divergence is now really starting to work in our favor. And if we can take out 380, then I think this qualifies as a double bottom, and we can see a little bit more upside. Mind you, it's all taking place within that longer term downtrend for the S&P 500. But we got to take it as it comes, and it means that within that downtrend there is a very tradable move potentially ahead of us if we take out that 380 level. There's a couple of things that I want to touch on later on when we talk about sectors that are still keeping me on my toes. But if we just purely look at the chart of SPY, it looks as if we are getting some sort of a relief after the decline from 430 down to 350, 360, and we're now going into potentially a rally. I think this rally will actually give us a lot of clues and a lot of hints on what we can expect further down the road. Especially because we will eventually form a new high. And where that new high will be formed and what kind of level that high is, how major that peak is, will tell us a lot about the current strength or weakness of the market. As a matter of fact, I wrote an article today aligning that with some sector work that we'll talk about in a minute. It's in the RRG blog if you want to read it, just on my RRG blog on StockCharts.com. basically arguing that the S&P is rallying while the major sectors, discretionary and technology, are still in relative downtrends. But we're going to take a look at that in a minute when we can start talking about sector rotation and the seasonality of sector rotation. Before we look at the seasonality for sectors using the 3D spreadsheet that I'm always using in this show, I want to grab back to seasonality for the market as a whole, and I'm using the StockCharts seasonality tool on the site. When you go to the seasonality tool and you type in, let's say $SPX for the S&P 500, this is the graph that you will see first. It's a 5-year histogram of the percentage of months in which the S&P closed higher than it opened. So basically whether it was a good or a bad month for the stock market. Now 5 years is a relatively short period, so I'd like to always extend it to the maximum, which is 20 years. And as you can see, we are in the stronger, or one of the stronger periods of the year. October and especially November and December are usually very strong months for the stock market. So we saw a little bit in October. You can define strength because it wasn't a fantastic month, but we didn't continue the decline that we saw earlier. And it looks as if we are, and I hope I argued that correctly in the article, and as I said in the previous segment, that it looks as if the S&P is able to rally, at least in the near term. And that could be underscored by the strong seasonal pattern for the month of November, followed by a strong month of December. And the right-hand side is the same information, just slightly different presented. And you can get that by clicking that button here. I did that to get this, so now I can have them side by side. And if I extend this also to 20 years, then you can see that this is, by the way, this is 2022. This is the current year, so you can see how how weak that is in comparison with the other 15, 16 years in this period. You can see in general markets going up, but more importantly, you can see that in October, November, December, if you would start here, you see that most of these lines are all moving higher. That's basically what these histograms are telling us. Now, even, and this is 2008, even in that year, you can see that at the end, the market stopped falling. So I guess that qualifies as a period of strength compared to the previous months. Now, this is the basic premise with which we go into the seasonality for sectors. So the market itself seems to be in a good place with seasonals pointing to higher prices for stocks in the month of November as well as December. Now let's take a look on how that translates into the seasonality for the various sectors. And here we go with the seasonality for sectors. And if we highlight the month of November, which we will be going into in a couple of days, well, next week actually, then you can see that there are actually two sectors that are really standing out. And those are XLB, materials, and industrials at 85 and 70. So materials at 70, XLB at 70, and industrials at 85. That is a very high reading. What it means is that in 70 and 85% of the months over the last 20 years, those sectors managed to outperform the S&P 500. And if you put it into context with all the other sectors in the month of November, then there is a very big spread, because if you look at the opposite side of the spectrum, there are quite a few sectors that are most of the time underperforming the S&P 500. So we don't see such a big spread, such a big diversion between sectors in a month. If we just go over them and look at the 30s, that is utilities and real estate. Only 30% of the time they outperform. That means that 70% of the time utilities and real estate are underperforming the S&P 500 in the month of November. And then only slightly higher is energy with 35, so 65% of the time underperforming. And then we have staples, 60% of the time underperforming, as well as financials, also 60% of the time underperforming. I'm going to leave it at that because otherwise we would talk about all of them. But it's quite interesting to see that two sectors are very high in the range, industrials and materials, and there is a cluster of sectors that are at the lower end of the range. And even more interesting is that industrials and materials are arguably a little bit more cyclical, while on the opposite side, so the sectors that are expected to underperform are more the defensive side. So it's staples, it's utilities, energy to a degree, and then real estate is really a strong underperformer. We're going to have a look to see on how that aligns with the sector rotation. But if you look at before we do that, we need to look at the average performance for those sectors in the month of November. And that is also an interesting read, because materials is at an expected or an average outperformance in the month of November of 1.1%. That's really high. And so is industrials with an expected outperformance or an average outperformance of 1.2%. That is also very high. And then on the other side, you can see the big moves in utilities, average minus 1.7 versus the S&P 500, and real estate minus 1.5. That puts the minus 0.7 for staples and the minus 0.7 for financials, although they are relatively big in a different light, so to say. So real estate and utilities, strong or big underperformance on average, and they are expected to underperform going forward in November, while materials and industrials are having high outperformance expectations, and they are at high odds of outperforming. So let's look on how that looks on a relative rotation graph and see if we can align that information with what we're seeing from the theoretical seasonal expectations. How does this translate to the current sector rotation? Well, I have the weekly RRG on the left, and let's go over the sectors that I just mentioned really quickly. The materials sector is one of the better ones. That has a 70% rate of outperformance, and the average outperformance is 1.1%. It's definitely in the right quadrant. It's moving up. It's picking up relative strength. It's got good relative momentum. If you look at the price chart, where relative strength is still caught in that trading range, and price is bouncing off that support. So there's definitely room for some upside. I would love to see this relative strength line break out of that range for a confirmation. But it's definitely possible that this sector will do better than the S&P in the month of November. The second one is industrials. And if you look at industrials, it's inside the leading quadrant, but at a very short tail. And if we bring that to the price chart, you can see that it is in a very stable uptrend. It's at the top of that range. It's losing a little bit of momentum. That's why it's bending over here, but that's only for today's price action, because if we would bring that to last Friday, then we're right here. So today doesn't really count for an entire week. But what I like is the completion of this small double bottom. That could bring it all the way up to 996, maybe even that falling trend line. Looks a little bit like the S&P 500. So for the industrial sector, it definitely looks like we're going to get a strong month of November. Even better than materials, if you ask me. Now, on the opposite side, we have a whole heap of sectors that are expected to underperform. So how are they in terms of sector rotation? The first one to look at is utilities. If you look at utilities, it's inside weakening and rapidly moving towards the lagging quadrant. And I can see that on the price chart. This is a nasty break, and that goes in terms of price, and it also goes in terms of relative strength. So the 70% of the months that utilities have been underperforming the S&P 500, that looks like a solid number. And the amount of underperformance, the average amount of underperformance is minus 1.7%. And utilities seem to be lining up to do exactly that in the month of November. If we go to real estate, then you can see that sector is in a real downtrend. It's resting at support, but look at that relative strength. That is in a real free fall, and that is, dragging those RRG lines lower, pushing the tail further into the lagging quadrant. So here also, 70% of the months it was underperforming over the last 20 years, and it looks as if 2022 is going to add one more month to that series, with an expected average underperformance of 1.5%. So utilities and real estate are definitely aligning with their seasonal pattern. Not so much the energy sector. Energy is breaking out to the upside. If you look at the tail, it's pushing into the leading quadrant. So the 65% of the month that this sector was underperforming, I don't think that we will see that in the month of November 2022. So I don't think that energy is lining up with its seasonal expectations at this point in time. And if you look at consumer staples, that is also a sector that is expected to underperform. 60% of the time it underperformed, and it did that by an average of 70 basis points. I don't think that that's going to happen in the coming month. If you look here, it's bouncing off that support area. The relative strength line is caught. It's basically in the middle of that range. There's no clear sign. So especially with utilities and real estate, with such strong alignment, why would we look for lesser opportunities if we've got those two really standing out? And that also goes for the last one. Why would you go with a sector which is not really aligning? This is the financial sector. The expectation is for an underperformance. It did that 60% of the time over the last 20 years. But there is only a little bit of room here. It's resting at support. Relative strength is in the middle of a slightly downsloping range. Why bother? Well, when you have utilities and real estate, which are really pointing to a further underperformance, and you can square those against materials and industrials. I think those four sectors should offer enough opportunities for nice pair trades if you're looking for them, or an outright outperformance or underperformance trade. And to wrap up the show, I want to get back to the article that I mentioned that I published yesterday, when you see this on Monday morning, about the technology and the discretionary sector at a negative rotation while the S&P is rallying, and how that is sort of not aligning. It's a confusing pattern that doesn't match. The pieces of the puzzle don't really match. And after I published this article, I thought, but what if that is only driven by the major names in the discretionary sector and in the technology sector? We all know how discretionary and sectors, these two sectors together, are 40% of the market cap of the S&P 500, but they each have a number of really mega cap stocks that are driving the performance of those sectors. So what I did is I added the equal weight versions of those sectors and the small cap versions of those sectors in one graph. And that gives me this picture. That's against the S&P 500. If you do that against the Dow Jones US index, then you have basically the entire US stock market. And if you look at that, it basically confirms the current weakness of those sectors. So it's not only those mega cap names that are showing that relative weakness. It goes across the board. And if you look at the performance against $1, then I hope you are now convinced that these sectors are really not in great shape on a weekly scale. They pick up a little bit on the daily, but the longer term picture for those major sectors in the market is still really, really weak. And that's it again for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. You can watch the show live on StockCharts television or catch the recording on YouTube or any of the on-demand channels. Looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.